Here's an uncomfortable question. If I asked you right now, off the top of your head, exactly how much money you'll need per month once you stop working, could you answer me? Not a guess, an actual number. Most people can't, and that's not a knock on you. It's just how it goes. Life gets busy, retirement feels far away until suddenly it doesn't, and one day you're 58 wondering if you're actually on track or just hoping you are. Here's the thing. Your retirement plan doesn't usually fail with one big dramatic mistake. It fails quietly, through small warning signs that are easy to miss when you're in the middle of everyday life. Work, kids, mortgage, the usual noise. So in this video, I'm walking you through 8 warning signs that your retirement plan might be in trouble. Some of these will feel obvious once I say them. A couple might genuinely surprise you. And for every single one, I'll give you something simple you can actually do about it, not just something to worry about. Quick note before we dive in, everyone's financial situation is different, so treat everything here as a starting point for your own thinking, not personalized advice. Let's get into it. Warning sign number 1, you don't know your number. Your number is the total amount you'd need saved to retire comfortably, based on your expected expenses. If you can't estimate this within a reasonable range, you're essentially driving without a destination on the GPS. Imagine 2 people, both 55, both earning similar salaries. One has a rough number in mind, say $900,000 by 65, based on their expected spending. The other has never calculated it. Guess who adjusts their savings rate this year and who doesn't? Action step. Today, spend 15 minutes with a free retirement calculator online, even a rough one. You're not looking for perfect precision. You're looking for a ballpark so you can course correct while there's still time. Warning sign number 2. You're estimating your expenses based on your current spending, not your future spending. A lot of people assume retirement will cost less because they won't be commuting or buying work clothes. Sometimes true, but healthcare, travel, home repairs, and helping adult kids often creep in and cancel that out. A 65-year-old couple retiring today can expect to spend well over $300,000 on healthcare alone throughout retirement, according to widely cited industry estimates. And that's before lifestyle costs. Picture someone like Diane, 61, who assumes she'll spend 70% of her current income in retirement because that's what everyone says. But she hasn't accounted for the knee surgery she'll likely need at 68, or the fact she wants to visit her grandkids twice a year now instead of once. Action step. Pull out last month's bank statement and actually categorize your spending. Not from memory, from the real numbers. If this surprises you, drop a comment with your current age. I want to see how many of us are in the same boat.
Warning sign number 3. You're relying almost entirely on Social Security. Social Security was designed to replace part of your income, not all of it. For most retirees, it covers roughly 40% of pre-retirement income, sometimes less. If your plan is basically, I'll get by on my check, that's a red flag. Think about Tom, 63, a retired mechanic. He assumed his Social Security check would cover his basics, and he'd figure out the rest. Then his property taxes went up, his car needed a transmission, and suddenly figuring it out wasn't a plan anymore, it was a scramble. Action step. Log into your Social Security account online and look at your actual estimated benefit. Compare that number, honestly, to your expected monthly expenses. The gap? That's what the rest of your plan needs to cover. Warning sign number 4. You have no idea what your investment fees are costing you. This one's sneaky because fees don't show up as a line item shouting, "I'm costing you money." They just quietly shrink your balance year after year. A seemingly small 1% annual fee difference, compounded over 20 years, can quietly cost tens of thousands of dollars in lost growth. Imagine 2 coworkers with identical retirement savings at 45. One pays close attention to fees in their 401k and rolls over old accounts into lower-cost options. The other never looks. Same contributions, same market, but very different balances by 65, purely because of fee drag. Action step. Pause for a second and actually pull up your 401k or IRA statement. I'll wait. Look for the expense ratio on your funds. If you're not sure what you're looking at, many providers have a free fee analysis tool, or a fee-only advisor can review it for a flat cost. Real-life example. Meet the Andersons. Let's put a few of these together with a composite example. Call them the Andersons, a fictional couple in their late 50s. He's 58, she's 56. On paper, they look fine. Steady jobs, a paid-off car, decent savings. But when they actually sat down and ran the numbers, they found 3 of these warning signs at once. They didn't know their real number, they'd underestimated healthcare costs by nearly half, and they hadn't checked their 401k fees in over a decade. The good news? None of that was a crisis. It was just information they didn't have yet. Once they saw it clearly, they had almost a decade to adjust. Increase contributions slightly, shop for lower fee funds, and build a more realistic healthcare cushion. That's the whole point of catching these signs early. Small adjustments now beat big scrambles later.
Warning sign number 5. You don't have a plan for healthcare before Medicare kicks in. If you're hoping to retire before 65, this one matters a lot. Medicare doesn't start until 65, and private health insurance in the gap years can be genuinely expensive, often running into the high hundreds or over $1,000 a month per person, depending on your state and health. Picture someone like Rick, who wants to retire at 62. He's budgeted for his mortgage, his hobbies, even a bit of travel, but hasn't priced out 3 years of private health coverage before Medicare starts. That gap alone could derail an otherwise solid plan. Action step. If you're planning to retire before 65, get a real quote for marketplace health insurance in your state this week. Don't estimate. Look up the actual number. Warning sign number 6. All your savings are in one type of account. This is about tax diversification, not just investment diversification. If everything you have is in a traditional 401k or IRA, every dollar you withdraw in retirement gets taxed as ordinary income, and required minimum withdrawals later on can push you into a higher bracket than you expect. Imagine someone who did everything right, maxed out their 401k for 30 years, but has 0 in a Roth account or regular taxable savings. Come retirement, they have limited flexibility on how to manage their tax bill each year because every dollar they touch is taxed the same way. Action step. Ask yourself right now, do you have money in a Roth account, a traditional account, and a regular taxable account? If it's just one, consider whether a Roth contribution or conversion makes sense for your situation. That's a conversation worth having with a tax professional, since it depends heavily on your specific numbers.
Warning sign number 7. You haven't stress tested your plan against a market downturn. Markets go down. It's not a question of if, it's when. If your retirement plan only works assuming steady 7 to 8% annual growth with no bad years, it's not really a plan, it's a best-case scenario. Think about someone retiring right into a downturn, pulling money out of a shrinking portfolio in the first few years. That early sequence of bad returns can do more damage than the same downturn happening 10 years into retirement because there's less time to recover. Action step. Ask a financial planner or use a retirement calculator that includes Monte Carlo-style stress testing to see how your plan holds up if the market drops 20–30% right when you retire. If the answer scares you, that's useful information now, not something you want to discover after the fact. Warning sign number 8. You keep pushing your retirement planning to someday. This is the quiet one, not a number problem, a momentum problem. Every year you delay actually sitting down and reviewing this stuff is a year you can't get back, and the fixes that work at 50 are a lot easier than the fixes that work at 62. Imagine 2 people at 60 who both realize they're behind. One starts today, adjusts contributions, delays retirement by a year or 2, cuts a few expenses. The other keeps saying, I'll deal with it soon for another 3 years. Same starting point, very different outcomes, purely because of when they acted. Action step. Pick one thing from this video, just one, and do it in the next 48 hours. Not all 8, one. So here's where that leaves us. None of these 8 signs mean your retirement is doomed. They're just flags, information that lets you adjust course while you still have time to adjust it. The people who end up okay aren't the ones who never had warning signs. They're the ones who noticed them early and made small changes instead of ignoring them. If you want to know exactly how to calculate your real retirement number in the next 10 minutes, watch the video I've got linked next. It walks through the whole process step by step. And if this one helped you see something you hadn't considered, hit subscribe so you don't miss the rest of this series. We're covering one money worry at a time, together.